Welcome to The Critique. Today we're looking at an analysis report that argues the recent stock slide of NBIS, that's NBIS, down to $98 is a major buying opportunity.
Right, and the thesis is really compelling. It says the massive jump in CapEx guidance that spooked the market isn't a risk, but it's actually just necessary spending to fulfill contracts that are already signed.
With giants like Meta and Microsoft?
Yeah, exactly. But for this to really land with a sophisticated audience, the conviction needs a bit more of a quantitative backbone. It's got the qualitative why, but we need the quantitative when and how much.
Okay, so that sounds like our first theme. We need to enhance the significance of that $5 billion CapEx investment through, well, more detailed financial modeling.
That's it. The report does a great job connecting the spending to the Meta deal and the Microsoft agreement. It proves the CapEx is necessary.
So what's the weakness?
The weakness is that it doesn't really quantify how that $5 billion investment turns into revenue velocity. And, maybe more importantly, when that new capacity is actually scheduled to come online and start generating cash.
I see. So the argument is qualitative. They have to spend it. But it's missing that quantitative bridge.
Precisely. And that leaves the market's biggest fear, the near-term profit hit and cash burn, feeling a little unaddressed by any real modeling.
That makes sense. The market is panicking about the cost today, so the analysis needs to show exactly when that cost becomes guaranteed revenue tomorrow.
Yes. So the suggestion for improvement is to really strengthen that logical flow. Dedicate a whole section to the expected return on invested capital, the ROIC, for that $5 billion.
And forecast the timelines.
And forecast the timelines for revenue realization. We have to define the efficiency of this capital.
So how can the report get specific there? I mean, hardware deployment, there's always timing risk.
Well, you could start by outlining the estimated time to delivery for the big-ticket items, like the NVIDIA Blackwell chips. You have to ask, when does that $5 billion spend shift from being a liability on the balance sheet to an asset that's actively generating guaranteed revenue?
That date is everything. If you don't put a firm quarter on it, the market just assumes the worst.
Of course it does. And for the ROIC, the report has to be explicit about the margin structure. It should state the expected gross margin targets for this new capacity. We're assuming these are premium contracts, right?
With Meta and Microsoft, you'd have to think so.
So if the expected ROIC is, say, 15% over the next 18 months, the analysis needs to clearly show the margin profile that gets you to that number.
Okay, so that covers the asset timing and the efficiency. What about making the link between the revenue and the expense more tangible?
This is a great way to do it. Model the impact of just the $3 billion Meta contract against the quarterly timeline.
Oh, I like that.
Yeah. You can project what percentage of the $5 billion CapEx is immediately covered by the revenue from that one contract alone. It basically shows that a huge chunk of the investment is, essentially prepaid.
That's very effective. It shifts the narrative from just generic spending to a highly targeted, contracted investment.
And that's the final piece. Frame the $5 billion not just as a necessary expense, but as a leveraging event. Put a number on it. Say it's expected to generate a 3-to-1 return over the next 12 to 18 months. You overpower the short-term cash burn story with a hard projection.
Right. You move from a story about spending to a calculation of inevitable ROI. That's a much stronger foundation. And that brings us right to the bear case, doesn't it?
It does.
The report correctly identifies the fear driving the stock drop, that this CapEx will crush profits, which is why you see that Zach's sell rating. But it seems to minimize the financial friction.
Which is a problem. The analysis needs to bolster its completeness by really stress-testing that near-term bear case. I mean, for a high-level report that's focused on robustness, you can't just be dismissive of the cash burn concerns.
It hurts the credibility.
It weakens the report's conviction, for sure. Especially with a company in hypergrowth, we're talking 355% year-over-year revenue. Volatility is part of the game.
But wait, if the whole thesis is about long-term contracted growth, why even spend time on the short-term noise like a Zach's reading? Isn't that just validating a flawed premise?
I see your point, but it's about meeting the reader where their anxiety is. That short-term noise is what created the entry price at $98.
Ah, okay.
If the analysis can't convincingly argue why the stock won't just keep falling to, say, 85 or 75 because of real financial pressure, then the buying opportunity isn't well defined. You don't ignore the fear, you dismantle it with data.
And you solidify $98 as the floor. So the suggestion is to add a dedicated section that stress tests the liquidity and the financial leverage.
Yes. Acknowledge and then quantify the potential for some temporary margin compression. Let's say in Q4 2025 or Q1 2026. This isn't about losses necessarily, but maybe slower profit growth from things like increased appreciation on all that new gear or interest expenses.
You give the bear case its strongest argument.
Give it its due, and then show exactly why it's a temporary issue that's completely overwhelmed by the contracted revenue that's about to come online.
Quantifying the short-term pain is powerful, but you also have to show the company can actually absorb it. What metrics would be key there?
They absolutely have to detail the current liquidity position, show the available cash, the credit lines, the debt-to-equity ratio. The goal is to prove that NBIS can handle this massive outlay without having to run out and do some kind of immediate dilutive equity financing.
Because if investors are afraid of dilution, they're not buying.
They will stay on the sidelines every time. A clear picture of liquidity takes that fear off the table.
That clarifies the internal health. But what about the external context? An investor might wonder if this kind of CapEx spike is normal or a red flag.
That's a great point. And that's where you bring in peer comparisons. The report should analyze the history of CapEx deployment for similar companies in hypergrowth.
So are we talking about looking back at, like, AWS or Azure in their early days? Or are there more recent analogies that would be more relevant to NBIS?
I think focusing on companies in the last, say, 3 to 5 years that executed similar multi-billion-dollar infrastructure contracts is probably more relevant.
Okay.
It provides context. It shows that a spike of this magnitude isn't a sign of mismanagement, but actually a very typical, very necessary part of executing massive, guaranteed contracts in this space. It validates the model.
That really elevates the analysis. Okay, let's talk about the final element, which is more structural. The report has this really powerful data point about market sentiment.
The options data.
The options data, yeah. It notes a heavy 67% skew toward call options between December 1st and 5th. A clear sign traders are betting on a bounce.
It's fantastic data. It's that smart money flow everyone's looking for. The weakness, though, is how it's used. It's sort of structurally isolated.
Like an interesting fact at the end?
Exactly. It feels supplementary, like a fun fact, instead of being integral to the conviction. It's the difference between saying, this stock is cheap and the options look good, versus the fundamentals are so strong that the smart money is now confirming the exact timing of the reversal.
Okay, so we need to optimize the structure by integrating these technical indicators as confirmation signals. They confirm when the opportunity is ripe.
You got it. The suggestion is to weave the technicals and the options data together to create a cohesive argument. It establishes specific, actionable reversal signals, which makes the whole report more useful as a timing tool.
I want to push back on that a little. How do we know that 67% call skew is really institutional, informed money? Couldn't it just be retail investors piling in after the drop?
That is a critical question, and the revised report has to address it head-on. The analysis should provide a more granular breakdown. Is that flow concentrated in large block trades?
Or is it thousands of small lots?
Right, because large block trades, especially the ones far out of the money, that's your signal for institutional conviction. You have to explicitly call that out as evidence that smart money is validating the fundamental thesis.
Okay, so once we've established it's the smart money, how do we use it to give a concrete timing signal?
You create explicit links. For example, you link that 67% call skew to the technical price level of, say, $102, which the material mentions.
You're creating a trigger point.
A trigger point. The report should explain that a sustained move above 102 is what validates those bullish bets. The options data provides the conviction, but the price level provides the actual signal to act.
And that helps define the immediate expectation for the reader.
It does. And you can go deeper. You can analyze the option structure itself. Is the highest volume of calls concentrated near the long-term analyst target of 160, or is it closer to immediate resistance, like 115 or 120?
Ah, that tells you if they're betting on a quick pop or just the long-term story.
It tells you everything about their timeline. It adds a whole layer of trading utility to what is already a strong fundamental report.
That is a huge improvement. So, finally, how would you restructure the whole narrative to make this work?
I'd restructure the flow to use the technical pullback, that drop from 141 down to 98, as the setup. The CapEx news is the catalyst that created the opportunity.
Okay.
Then, you position the 67% call options flow as the primary short-term catalyst that confirms the opportunity right here, at 98. The technical set the stage, the fundamentals are the foundation, and the options flow signals when to pull the trigger.
That's a complete, actionable thesis. Not just on value, but on timing.
Exactly.
Okay, that's a powerful framework. We began this critique with a really strong fundamental thesis, that the NBIS slide is a buying opportunity. To really